Let's talk about one of the most frustrating things in trading, right? The failed breakout. But what if I told you it's not just bad luck? What if it's actually a feature of the market, something that happens entirely by design?
Think about it. If breakouts really worked the way the textbooks say they do, well, most traders would already be profitable, but they're not. And that means the conventional wisdom has a massive, massive blind spot.
You know, we're all taught this one simple rule. Buy above a key high, sell below a key low. Sounds logical, right? But the reality we all face is this infuriating cycle. You follow the rule, the price breaks out, and then, bam, it snaps back aggressively, stopping you out for yet another loss.
So what is really going on here? Why does this pattern that's supposed to be so reliable fail way more often than it ever succeeds?
Well, the answer isn't bad luck, and it's not that your analysis was wrong. The real reason is one single powerful concept: liquidity. And I'm telling you, understanding this will completely change how you see the market.
So what even is this liquidity thing? Well, it's basically this huge invisible pool of active buy and sell orders in the market. For most of us, it's just kind of background noise. But for the big institutions that need to fill these massive positions, for them, hunting liquidity is the entire game.
And here's how that liquidity gets created. It all starts with a really obvious level on the chart. You know, a clean, tempting high or low. That obviousness, it creates confidence. And that confidence leads to really crowded trades. And all those orders, all clustered together in the same predictable spot, they form a giant concentrated pool of liquidity.
All right, let's break down exactly what's in that pool. As price gets close to a high, two groups of people start to act. First, you've got the breakout traders, and they're placing buy orders to go long. But at the exact same time, you have the short sellers, and their protective stop-loss orders are also waiting there, which, guess what, are also buy orders. So both groups are stacking up buy orders right above that super obvious high.
Now, this cluster of buy orders is anything but random. It becomes a massive, predictable target. I mean, think about it. If you're a huge institution and you need to sell a massive position, where's the absolute best place to find millions of dollars in buy orders to sell into? Yeah, right above that obvious high.
This right here is the anatomy of the trap, step by step. First, the institutions spot the obvious level where they know liquidity is going to build up. Second, they just let the price drift towards it, which encourages all the retail traders to get set. Third, they engineer a push just through that level to trigger all those waiting buy orders. Fourth, and this is the key part, as all that retail buying floods in, they sell directly into it, filling their massive short positions. And finally, fifth, with all their business done, the price is totally free to reverse.
This is the core logic you have to understand. From an institutional perspective, the purpose of a breakout isn't to start a new trend. No way. It's a calculated move designed specifically to trigger the orders that are just resting right above or below that level. You see, they need your orders to fill theirs.
I bet you've seen this sequence 100 times. Price moves cleanly up to a high. It just pops through, and you feel that rush, that confirmation. But then, it just pauses. It churns. That little pause is the sound of institutions absorbing all of those buy orders. And once they're done, the price doesn't just drift down, it collapses aggressively.
And it's in that moment you finally realize the breakout wasn't the opportunity.
It was the trap. The whole thing was designed to lure in one side of the market just so the other side could take their positions.
After a trade like that, most of us immediately think, man, my setup was wrong, or I totally misread the market. It's just a natural reaction to blame yourself.
But here's the twist. The setup wasn't wrong. In fact, you could argue it worked perfectly. The breakout did exactly what it was designed to do, create a huge, juicy pool of liquidity. It wasn't a failed trade, it was a successful liquidity grab.
So it all builds into this really simple but powerful logic chain. Breakouts are predictable. That predictability creates liquidity, and that liquidity is what attracts the institutions. It's a self-reinforcing cycle that happens over and over and over again.
So if you only take one thing away from this, let it be this. Breakouts don't fail randomly. They fail by design. Okay, so what does this all mean for you? It means it's time for a shift in focus. Stop chasing the obvious entries that everybody else sees. Instead, start learning to read the underlying price behavior. Ask yourself, where is the liquidity and who is it for? If this changed how you see the market, subscribe for more explainers that decode how price really moves. And the next time you see that perfect breakout forming, just ask yourself one question. Am I the hunter or am I the liquidity?